Equities at record highs, bond yields at record lows. It's been a heck of a week on the markets, and with me down the line to try and make sense of it all is Dawie Roodt. Dawie, so it's the last trading day of the month that's been equipped with a deluge of data, a raft of Fed, BOJ and ECB speakers. Greece has been taken off the table as a major concern, at least for now, but what would you say has been the biggest market move this week?
Well, without a doubt, I would say the real blue chips are the main market movers this week. We've seen the major companies, the big companies, reaching in some instances, record highs. And I'm getting a little bit concerned about. Clearly what is happening is that clearly a lot of these companies certainly do have the earnings to support very high valuations. But I'm concerned that a very loose monetary policy globally is also contributing to some of these recent highs that we've seen. I'm getting a little bit concerned about global equity markets. I think they're getting a little bit toppy.
The ongoing story is the Fed trying to allay investors' fears over raising rates. But given that we've seen outflows from EMs over the last 18 months, are these jitters misplaced? Is the hike already largely priced in?
No, I don't think an interest rate hike is necessarily priced in the financial markets. Part of the reason why I say so is because we've recently seen especially the bond yields coming down a little bit. We've seen bond yields going up from below 2% to above 2% the last 2 weeks or so, but the last few days we've seen bond yields again dropping to below 2%, especially after Yellen's speech. So I'm not so sure that the interest rate increase is necessarily fully priced in. In fact, I think there's a very good possibility that we could see interest rates going up even later than what most analysts at the moment are predicting.
The ECB is out the market at the moment, but given the situation where 1/3 of Europe is negative on bonds, when the lender decides to come back in, will they be able to buy bonds?
Yeah, that's very interesting what is going on in Europe. I think it's a combination of a number of things. We know, of course, that the ECB is buying bonds, or at least planning to start buying bonds quite aggressively, and I will not be surprised if we see an acceleration of the bond buying by the ECB over the next couple of months. Apart from that, we also, or at least there are possible fears of the possibility of a breakdown of the euro area. And I think that is part of the reason why we do see, in some instances, yields trading at below zero. So clearly, the difference between the peripheral bond yields and the bond yields of countries like, for example, the Germans and the Danes and some of the other northern European countries is simply pricing in the possibility of a possible breakdown or a break-up of the euro area. And that's a contributing reason. But of course, the ECB's contribution to monetary policy approach at the moment is certainly contributing to overall relatively low levels of yields.
And lastly, Dawie, what should our viewers keep an eye out for next week?
What we need to keep an eye on for, I think the single most important number in the world today is simply what is going on with US 10-year TVs. The US 10-year TVs came down and then went up again, and I think what's currently happening is that the yields are coming down a little bit, and as far as I'm concerned, the 10-year TVs of the US 10-year TVs is the single most important number that will tell us what is going on with the globe's economy. Clearly, with bond yields going below 2%, the capital markets are telling us that global economic growth is not likely to be as strong as what many analysts have been predicting. And if the bond yields fall even further, then I think we are in for difficult times globally.
Dawie, thank you for your insights. Well, that's all from Dawie and myself, but continue to keep on top of your trades by staying with us here at Dukascopy TV.